Welcome to Startuprad.io, your podcast and YouTube blog covering the German startup scene with news, interviews, and live events.
Hello and welcome everybody. This is Joe from Startuprad.io coming to you today with another subject matter expert. When Paolo says his first words, most people will recognize him. Paolo again. You most likely don't need an introduction, but I'll still do it because we're growing like crazy. I welcome you back to my podcast. You are the most frequent guest on Startuprad.io. You are a thought leader in the world of fintech and banking. You're a trusted expert in the intersection of technology, banking, and capital markets. With years of experience at the forefront of banking innovation, Paolo's insights are shaping the future of financial services. Today, we'll be discussing his latest research at the IBM 2025 Banking and Capital Markets Outlook and how it will influence the next generation of financial strategies. Paolo, welcome again to my show.
So with such an introduction, I have to start with the right foot. Buongiorno, buon pomeriggio, buonasera to everyone, wherever you are in the world.
As we are at the start of a new era in banking and capital markets, one question dominates. How will emerging technologies like AI, blockchain, and digital currencies shape the financial world in 2025 and beyond? Today, we are diving deep into the IBM 2025 Banking Capital Markets Outlook with one of the leading voices in fintech and banking transformation. Stay tuned to discover what the future holds for financial institutions, investors, and entrepreneurs alike. And we also may tell, because most people are listening to this, your name tag also say the Banker's Bookshelf, so you're also podcaster there.
Yes, I am. I'm following your inspiring episodes. So the Banker's Bookshelf is the opportunity to have on the show the most interesting book authors and researchers that are helping us to understand the present of banking and its fintech future. So happy for you to also attend our episodes, but we can share some key insights here with you, Jorn. So this is a wonderful podcast. I'm always happy to get back. This is amazing. So let's make it happen.
Happy to come over for recording to you. Paolo, in your recent research with IBM, you highlighted the growing importance of AI in banking. How do you envision artificial intelligence reshaping the landscape of banking and capital markets in 2025?
Well, there's nothing new, right? So just to say that it's becoming important. Let's put it into perspective. So maybe this helps to understand where the industry is effectively leading to. If we go back 15 years ago, say at the start of the global financial crisis, which is always an important moment in time in the history of banking, back then banks realized that they could not operate the way they were operating before because their capability to generate revenues was much more reduced. I guess before there were few excesses. And so there was also the time when digitalization started. The iPhone was invented in 2007, more or less. So we saw a growing trend of people being more inclined to use the website or even start using a phone for doing some basic banking transactions. So for the banks was a no-brainer to say, hey, let's close branches, we rationalize because we can push some of those activities on a website and then on an app. But in essence, that didn't change the way banking was working. It was primarily a lift and shift of a branch on a digital architecture, which in many cases meant more investment in cloud computing and APIs to power up banking in a different way, not in the premises of a branch, but mediated by a technology piece. So that I would call digitalization of right. Of course, at the very beginning, banks were like, can I use cloud or not? Regulators learned that maybe that's important, so they started doing it. Banks realized that just having an app on a phone or a nice website doesn't mean that clients are comfortable in navigating through. So they started thinking we need to personalize that. So we moved from an age of digitalization of right into an age of personalization. And how do you personalize? You use AI. So they started using machine learning in particular to in a sense, manage the SEOs, so to create the content more relevant for the client, to streamline the processes, make onboarding a bit easier, less clumsy. So that's a period where AI starts entering the banking scene in variety of fields, but in particular there when you have to do banking activity on mobile, when you do a bit more automation, you need to streamline the processes. But still, that was not enough to shift a lot of important operations from a face-to-face branch onto the digital app. Now, if generative AI is famous for something, it's about communication, language. So I think that now we're entering the stage where we had years where we had digitalization to core as a key theme, years when we started talking about personalization, and we could use AI, machine learning in that respect. But now it's about communication in many cases. So how can you transform the way you effectively talk to clients? As well, I would say, the way you talk inside the organization. And that is where AI has now more capabilities to transform the way banks operate, because up to the past was sort of a linear approach in terms of plugging in an algorithm here and there where you could grab some value. Now you can rethink the way effectively everything works inside the bank and in front of the customers.
Actually, as you said that, it kind of reminded me we first talked about cloud, yes or no, crypto, yes or no. Now we're talking AI, yes or no, and it was always a slow approval by the regulators, and then the banks went in more or less over time.
And there's quite of misunderstanding there that come to the surface with time. We could have seen that at the very beginning, the strong of push of narratives around, but we see that. And if you think about cloud is not what many expect it to be. The economic model of cloud that doesn't hold through in many cases. Now private cloud can do as much as public cloud, and so I don't know what the hyperscalers are thinking. Actually, I see the hyperscalers trying to move on-prem, if you like, compared to the propositions before. Lots of institutions realized that with growing volumes, the thing was not operating as expected, so it's an hybrid cloud mix. The crypto world as well, of course, there was a lot of fantasy and excitement, and there is still for the pure crypto world, but now we're leaning towards a different aspect, which is around the regulated space with the CBDCs and the stable coins. So it's more like going there where it is traditional, though with technology, instead of taking a direction where it is completely revolutionary, right, but out of the mainstream. Some of these elements have been, if you like, digested inside the system as well. That's true, but it's very different from the early stages, proclamations of, if you like, total decentralization and transformation. And with AI, maybe it's the same, right? So we are going through phases to understand exactly what it does, what it can do, what it can do. It's so easy to get wrapped into a hype that doesn't help anyone but a few. AI, however, is different from the previous two because AI started in the 1950s, so has a longer track record, okay, in terms of usage and understanding. Even before generative AI was already part of banking. It was just talked maybe with less emphasis from the general public compared to what it is today. And what is happening is now the technology is becoming more accessible and more flexible, which typically is important when technology starts unfolding real value for transformation, because it cannot be just rigid, so it needs to be adaptable in a sense. Now, that adaptability is not risk-free. It requires professionality. It requires a good risk management approach. It requires platforms and architectures to execute it. And that's where we will see the differentiating elements. It's not about who has the best AI, but it's about who has the best way of using AI, which is a different type of investment in IT. AI is becoming more open source, is multimodal, is multimodal. So that's the story. But for a long while, we thought about the best AI is the best institution. It's the best way to use it. It's not the best.
I actually totally agree with you when you talked about like the new technologies going into the old ways. What came to mind is the tokenization of securities that is currently ongoing. And I also thought about application of AI, basically it's a nightmare for a bank because you have to keep track on all the AI agents you have there. They're working there because not one agent from one department and an agent from another department do something like crazy, shifting money back and forth in the billions on seconds basis, and then you have a big mess. Nobody wants that. Before we get too far, for our audience, for our listeners, how are you or your company preparing for AI's role in the future? Feel free to share your thoughts on LinkedIn or Twitter, or let's connect.
No, I think that you hit the bottom of a propeller into the future. You talked a lot about agents. Agentic AI is coming as well. We're not yet there, to have that complex system that operates through agents. But that's another interesting evolution of technology, which is getting more and more prone to make decisions which are unstructured, they're not part of a defined rule set, and take responsibility for that. Which could only be dreamt about years ago, now is becoming effectively a reality where people want to engage, down the road into that type of configuration is another story, but effectively this is happening as well.
When I was thinking about how a bank could use AI, of course, what came to mind is like a lot of manual tasks done in the background. But then a lot of banks would need new systems where AI agents could access. Plus, you need to kind of a controller of all the AI agents, make sure they all work properly. You need to document them. You need to monitor them. So I'm not too sure if like there's a huge win in efficiency there. What are your thoughts on that?
It's another key point here, the way you measure it, but also what you want to do with that. Because if you don't unleash new value, is a zero-sum game in essence, right? Or is you reach a floor, so you cannot expand further. So the point is, how can you do it not just to simplify what you're doing, but then to create something new? Because that's where you justify most of the investments. If you look at the cost structure of banks, so the total operating expenses, I give you a number, which is about banks worldwide, and that it could be differences bank by bank or across the regions. From 2007 until 2024, the percentage of cost that banks had to spend for people, which is a good cost, salaries and benefits, went from 50% to 54.6%. The percentage of expenditures in technology, tech and com, went from 6%, a bit down to 6.6%. So the amount of cost allocated to the workforce increased over time, notwithstanding all of the investment in technology. There are a few reasons for that, but that tells you that essentially banking is a people business anyway. And if you want to get benefits out of automation with AI or agentic AI, you always need to ask yourself, how do I also augment the employees to do something more, something different? Because if you don't put both elements into the right perspective, you may not justify the economic model anyway, for the good and for the bad, right? So that is, I believe, the most complex things that bankers have to do, because they not only have to innovate what they're already doing, automatizing it, because they have to change it, automatize it that way, but they have to imagine how to do things differently, okay, or new things, and you really have to think out of the box. But hey, we have hundreds of banks worldwide, thousands of people working on that. I'm sure that here and there we see good ideas popping up.
Mm-hmm. We've spoken quite frequently about neobanks and fintech startups disrupting traditional banking models. What trends in 2025 do you see that will allow these fintech players to continue to challenge incumbent banks? And where do you think established players need to innovate?
That's me a lot. Because end of last year, in September, October, I published new research dedicated to banking for small and medium enterprises, commercial banking, putting on the side the solo entrepreneurs, which are more like retail, so small and medium enterprises. Say companies with more than 50 employees and below 200 million of revenues, maybe 100 million in places like Brazil. Why does this excite me a lot? Because this is where the competition between bank and neobank is intensifying in the next 5 years. And there's a reason for that. The last 7-10 years were about retail markets, which are overly commoditized. And there to move the needle with technology, you really need to get into larger volume. That's why Revlo needs to have more and more clients. Nubank got 100 million customers in Brazil and is still growing. So you need to get to a very large scale to grab all the benefit in retail markets with this type of transformation technology. So it's not for all. Corporate banking is not for every player. It's really a relationship on a few. And capital markets, again, is for a few banks that have the shoulders to basically do trading and become more prominent in that highly volatile space. But small and medium enterprises are everywhere in every country, in Germany, in Italy, in Brazil, in Portugal, in China, in Australia. And they were not served that well by banks, or banks could not invest in transforming their services. So the fintech in the past years for a few reasons, because all of these clients, the SMEs, are very different. You have a restaurant, you have a dentist, you have a lawyer, you have a travel agent. So for the bank or the fintech to talk to these communities is complicated, because you have pockets of communities, different ecosystems, which have different problems that pop up at different times in the economic cycle, which have different ways of reporting their numbers, and their data is not structured. So the cost to serve in banking for the SMEs is the highest across the group of clients. Now, given the latest 2-3 years advances in the AI capabilities, I think that now we're at a point where that problem can be more easily tackled, because with the combination of traditional and generative AI, now you can basically have new means to systematize the process of onboarding and understanding these ecosystems, and therefore lowering the cost to serve, which can be passed to the clients in terms of a lower lending rate, making the bank more competitive or the fintech more competitive without consuming the prudentiality, okay, because giving away for free has never been a good idea, and you see clearly, the Marcuses of the cases and so on and so forth. So now, given the fact that AI made a leap in terms of capabilities, especially with the large language models, and the fact that that segment of the market is where the cost to serve is the highest in banking, any dollar invested in the transformation of that business can generate the biggest benefit, so the highest return on investment. But 2-3 years ago, I guess, was too early, so was not yet possible. So the economic model was not working. And then last but not least, these companies are like the 3TP in the gold mine, that the first to suffer when there's an economic downturn. So of course they tend to be riskier. And now is where the opening of a lot of ecosystems through the API economy allows to ingest new data in the risk management model, even just with a traditional machine learning model, that might allow to better risk manage the positions with these ecosystems that are varied, and they need to engage a bit more on digital compared to what was happening so far. So even in that front, I think because of the API economy spreading around banking more than in the past 5 years of open banking, getting open finance, now things are possible that were not possible before.
Mm-hmm. When you've been talking about the capital markets, what I had in mind, what used to be called, for example, flow monsters in some research, big banks with big organizations, where it doesn't make a difference if you have 2-3 additional billions flowing through a day, but they generate additional profits for their talking about economies of scale. That kind of leads me to the capital markets transformation. The capital market sector has faced various challenges over the last decade, according to IBM's outlook. How are emerging technologies expected to impact investment strategies and asset management by 2025?
So when we talk about asset management, we need to tell us also a bit of the truth about capital markets. So this is an industry where few people pretend to know too much about the future and know nothing, because fundamental uncertainty is the structure of the market. And a lot of people, all of us, are afraid not to know anything about the future, but we know enough to be prudent in essence, right? It's just that in the necessity of positioning all, financial markets, capital markets is a retail market, because in the end, even pension funds, are for the retirees. There is a way narratives are created and opinions are generated to talk to people. Now, the question becomes, Do you have now a better capability to predict the future because of technology? That's not the point. I think you're not getting into more predictions. You can have more capability to compete algo to algo, which is different than predictive, but you still have the same old problems to basically position yourself in terms of understanding the market. What is changing, however, to me is the following. As every activity that happens in the hyperspace of capital markets needs to boil down into a conversation that has to be had with a client that needs to make a decision about their investing, is the capability to better inform people about how they can make their decisions in a world that is very uncertain, but testing the hypotheses, right, and creating more easy conversations, right, to grasp that can transform the way we are building the various bets in capital markets. So that is where I see the biggest transformation happening. For the rest, of course, modeling is always en vogue. What matters there is that the model of the bank that has the biggest shoulders, it becomes the dominant model because it's paid for pricing, and everybody else is a price taker. But I think that would be for banks a business as usual. We're not going to crack, if you like, the market. We have just one case of somebody that apparently solved the market. We don't know yet how he did that, whether he did that. Renaissance Technologies would be interesting to learn more, but we don't know much about that. But for the rest, I think that the structure in itself doesn't change. But what can change is the way people can access and advisors can talk to people, right, for a lower cost. They might transform the way they ask, basically, to tap into opportunities in capital markets, therefore changing, if you like, the average hour of the trading floors.
When you talked about the person who sold the market, I'm very sure there are a handful of projects out there in the world where somebody's trying to train an AI to think like Warren Buffett.
Well, Warren Buffett did not solve the market in a sense. There was more Renaissance technology, but Warren Buffett as well was very risky. Now, successful, you see, is very different process. Warren, you can make a lot of money because you have you're very concentrated in your bets, or you can lose a lot of money because you're very concentrated in your bets. And then overall, in the long time, if you buy the market, more or less, you are there. So Warren Buffett is an example where he was very specific in his bet, which could be very risky, but is a very complex thought process. It doesn't conform with high frequency trading or automated trading in that respect. And again, if you try to imagine what's beyond the curve, not knowing what will be beyond there, you try to imagine something which is not in the data. Then the data may inspire you, but you get your intuition to go beyond that, and that's very hard to be replicated, whether it can be replicated.
For our audience, what changes do you think AI and blockchain will bring to the investment space? Drop your comments below the episode to let us know what you think. Paolo, we'll be back after a short ad break. Paolo, guys, everybody, welcome for coming back. We're still talking to Paolo Sironi, thought leader, podcaster, and awesome person here on Startuprad.io, plus the most frequent guest. Now we get into, unfortunately, a little bit the boring but necessary part of this, the regulatory and risk management in AI. What AI and automation transformation? How do you foresee regulatory frameworks evolving to ensure that AI-powered systems in banks remain secure, ethical, and compliant?
I never thought that risk management is boring. Maybe a regulation could be. But whenever
I completely forgot you are former risk manager. I'm so sorry.
A lot of work to do and stuff. It can also be fun. And now, you know why it's not boring? Because being based on data, and data is always corrupted. So, you can get entertained, every day with something new problems popping up that you have to resolve. So, but it's a very important question because this question contains the solution to most of the problems. Let's start saying this. In the 1990s, CEOs of banks used to say that every one of their employees was a risk manager. because risk management is the core business of a bank, managing the bank's risk or the risk of the clients. Now I'm saying every banker must be an AI risk manager. That means needs to understand how to manage the risk of AI, also the risk with AI, but how to manage these algorithms or this new way of working. And why is that important? I was actually talking to the global CIO of one of the top 10 banks in the world a few days ago. And we asked him the question, how do you, what is missing to scale AI enterprise-wide in financial institutions? And basically said, well, is the reinterpretation of the role of the CRO and the risk management area. Because AI being an algorithm, that's about validating the algorithms, right? And creating the confidence that the algorithm can be used and deployed, right, in a business process. And the confidence is to be higher and higher the more the business process is highly relevant. And typically, wherever you touch a client is one of the most relevant, model. And so it goes in the past, the old risk management infrastructure was based on validation of defined algorithms. Think about Basel II, Basel III, Basel 26, which is a large set of rules that stick together. Then you run them, you test them, and then you can validate them, you know what they're doing, and you can prove that basically they do what they're expected to do. And that's a lengthy process, but it's very focused. With AI instead, it's not that you validate one AI, you have hundreds of different use cases in utilizations of that AI that needs to be understood and validated, where the data is used in slightly different forms, where the reactions and the positioning of the algorithm is differing from what you might expect. So how do you transform the risk management into a function that interacts in the continuum with the process? Now, if I now think about the regulators that are looking at all of this, the biggest challenge that they have is that they need to start understanding that the risk management function and the validation function needs to get transformed. It's not anymore a process where you define the rules, things happen, and then you revalidate when what happened conform with those rules, and so the algorithm also performs. It has to be more in the continuum, which poses a problem of independence, right, of the various functions. But the point then is therefore, what are the platforms and architectures that would enable to make this renewed interpretation of the risk management function that interacts with the way technology now asks you to basically interact with the problem or the opportunity that is different from the past. So I was very, very inclined to try and understand how many banks are now making those investments in a way that they can position themselves more capable of embracing this change anytime it happens, being strategic in their approach to AI and to generative AI. And what I found is that only 8% of the banks worldwide have a more strategic perspective and approach to the deployment of the latest advances in AI, while 70% of the banks wants to do it, but are very tactical. That means that they start here or there where there's more interest or some money on the table. And that's not enough because it will not enable them to build that risk management culture that differentiates. In fact, what I saw is that it's not about the biggest banks versus the smallest banks. It's about the banks with a certain culture compared to banks without the culture. And the culture, big or small, is complex to build, right, and to, if you like, promote in an organization. So that's my answer to your question. That's how the regulators should change, but that is exactly where you find the solution to the problem, not because you have a compliance that makes sense, but because you have a culture based on this new interpretation of risk management that enable you to tap into what the technology can enable you to do with transparent comfort.
In your research, you mentioned digital currencies. Central bank digital currencies will play a big role in reshaping the financial ecosystem. Can you give us like a very small wrap up? What are you thinking forward from here?
Well, Minister Lagarde in Europe, at least for the European audience, said that in September, October, they will define the remaining shape of the roadmap. Okay, so on whether and how, basically more how than whether they will go ahead. So there are serious discussions in terms of the creation of CBDCs. Some of them have been created, not totally successful, right? But there is a need at the moment of experimentation. The only thing that I believe is to be considered here is the following. If you look at what the Brazilian did with the PIX, which is an instant payment framework that will evolve at some point into a CBDCs, but is not, they got massive adoption in a few years because they just resolved the real problem with simple technology in essence. Okay, that was the first thing to allow anyone to use instant payments, to bring the security and clarity in the transactions. CBDCs are a bit over-engineered as far as I see. So every time it is over-engineered, that has a harder time to fly. So still have to see where, the ambitions map the simplicity needed to operate these things on a very large type of infrastructure. The Americans now are moving in the direction, say no CBDCs, but a stablecoin. So it's interesting to see how they are positioning. And they are all still positioning, right? Positioning is moving, but is not executing in full. But I think the 2025 is the year where we will get clarity on this, at least across the Atlantic, in the perspective the European versus the North Americans.
Also a topic we've been talking about years before, embedded finance is another trend highlighted in your report. There's a growing integration of banking services into non-financial platforms. How will this change how consumers and businesses engage with those financial products?
Okay, so embedded finance is an important element of transformation. It is not a one-size-fits-all in terms that not all of the banking services can be easily or seamlessly embedded into a non-banking conversation. And it's not about technology, it's about the way effectively people deal with uncertainty around the consumption of certain financial instruments. And it's not because people are not capable, need to be rewired, it's just structurally so, biologically speaking. So it has been an opportunity for banks to say what we have now can be consumed at the time and in the moment and in the location of need. And that remains particularly relevant for types of payments, the need of money like lending, and sometimes also insurance, some products and some investing. What I think is happening is that it's not enough to have a platform that allows your banking capabilities to be consumed by somebody else to be successful, because they need to be wrapped into a business case that makes a lot of sense. So when I interviewed the head of open banking of the major players in the world, that's what they basically said. They said we're moving from a transactional perspective into the realization that what matters is that use case. So it's a different way of selling the technology from a bank to a non-banking player. But also we saw banks effectively investing to orchestrate ecosystems. And that has been growing in the last 5 years. Not only DBS attempted, they made 5 of these. We have Chinese banks doing so, but also Bradesco with the agro that takes care of 50% of the Brazilian economy. Strice launched it 2 years ago, successful, making inroad into that type of business, and then thinking of how to expand to different ecosystems. So we have State Bank of India with Yono, which is a marketplace for retailers that now is aggregating SMEs, so the merchants, into the platform. Both of them created an external entity to operate the platform, but that built the platform. Okay, so that's interesting. One thing that I want to say here, which I believe is important, I was talking to the head of a very large bank, I just don't want to mention it, they launched a few months ago a platform for the supply chain of SMEs. And the platform is intended to allow the SMEs to trade the one with the other. Now, of course, there was around the table excitement where we heard about that in terms of you're competing on payments, right? Because every time people transact, right, that's where you make the money. But the response was no. The point is not the payment. The point is my role is to lend as much as I can, keeping the risk under control. Okay. But to do so, I need to have data. So can I better understand the ecosystem if I have that ecosystem to be orchestrated digitally so that I can go back to the CEO of the bank and to his manager and say, hey, now maybe we have a way of understanding everyone in the context of the ecosystem. So we are more, if you like, comfortable in doing that business online. So you see, the value of these non-banking platforms not necessarily is the non-banking transaction, but maybe what it enables you in terms of risk management to do your more traditional business in a more substantiated way. So that I found very interesting. I always say that it is the opportunity to basically embed that, to eliminate the friction that makes the banking embedded, to generate new value, that the definition of having banks and fintech or platform economies. So when I say new value, I mean new value is not the transaction, it's somewhere else. And that is an example that I just like to share. And I see bankers, more and more bankers are understanding this. It's a steady, long-term process, but it is happening.
Talking about mentioning here, I have one more question for the role of AI in wealth management for you, and then I'll just hit a few highlights of the topics you will be talking about, so the people need to go to read your research. And of course, we'll link the report down here in the show notes. I also do have taken some notes. We'll link your research, your LinkedIn profile, a lot of your books, your podcast, Banker's Bookshelf, plus your SME research that you just mentioned here. And now let us get to the last question I'll be asking you, the role of AI in wealth management. Looking ahead, how will AI and generative technologies impact wealth management, especially for individual and small to medium enterprises?
Okay, so a very broad definition here, but let's say that in the wealth management space, you have the need of creating the products, okay? And there's a lot of compliance around that. So I do believe that now there are possibilities to better streamline and systematize the way a lot of this documentation is prepared and orchestrated. That doesn't mean that the banker is out of the equation, but the capability the bankers have to perform to systematize that documentation is effectively augmented. And that's where I see a lot of basically use cases being deployed by institutions that are prominent in the wealth management space. There will be a time where there will be more effective communication. I think it will still take some time for that. But at least in terms of lightening up the compliance burden, that is an opportunity right now.
And of course, as promised, I'll hit some of the other highlights you have in the research report: sustainability and ethical innovation in fintech, future investment trends, role of digital transformation in banking, global banking insights and regional differences, and emerging risks in fintech. As we're wrapping up this insightful discussion with Paolo, we want to hear from you. What are your thoughts on the future of AI in banking? How is your business preparing for those technological shifts? Let us know in the comments below, or connect with us on LinkedIn or Twitter using the hashtag banking2025. Paolo, your last words, please go ahead.
I published in 2019, launched in the World Economic Forum and a week before in Hangzhou, China, as a preview, the Financial Market Transparency Theory and Principles. So transparency builds trust. Not only transparency is a matter among people, but definitely is an issue with technology. And I'm not surprised that most of the business people are asking AI to be extremely transparent. So that is a principle that we all need to look at. So if the algorithm is transparent in the incentives, first of all, and therefore in the, if you like, positioning of the conversation with the clients, which brings with itself then cascading down different elements that can be on the bias, on the race and whatever. So there's a multiplicity of elements. But the question is, how did you embed the principles of transparency in your technology process? There is a reverse effect now, because by looking at technology and asking technology to be hyper transparent as it should, I see the bankers looking at themselves and therefore reviewing the way they position themselves in front of the client, because the moment you ask technology to replace what you do and be very transparent, they basically declare the incentive of the system. So there is a very interesting, if you like, reverse effect, as I called it. So I'm looking closely at how this evolves, because that is a key turning point in the transformation of the business models that is essential, especially when you want to use technology. And that's the reason why I published the financial market transparency theory as a positive theory that enables to look at the markets differently, and it's positive theory because it can be transformed into a business model. And I discussed those business models in my latest book, Banks and Fintech on Platform Economies, looking at contextual banking and conscious banking, embedded finance and the advisory platform. So it all is consequential. So really, by asking to be transparent, we have as a reverse effect, if you like, an opinion about how transparent they've been as bankers. And from there, a new business model can be generated the way that value is created for everyone in the ecosystem, not just for the bankers.
Amazing closing words, Paolo. As always, it was a pleasure talking to you, and maybe next time we talk, you're the host and I'm the guest on your podcast.
Okay, welcome.
Great. Have a good day. Bye-bye. Ciao, Paolo.
Arrivederci.
That's all, folks. Find more news, streams, events, and interviews at www.startuprad.io. Remember, sharing is caring.